the trade deficits don't matter. They do matter. It's just that people don't realize it. But when the markets start to fear these trade deficits, that's when it matters. But I guess then it's too late because now you've got a crisis. It was another strong week in the stock market thanks to a hopium-inspired rally that the Fed may pause in its rate hikes by the summer. The Dow Jones ended up about 1 3/4% on the week, finishing with a strong day. Dow Jones was up almost 400 points today to close out a relatively strong week. S&P did even better than the Dow, up 1.9%. Russell 2000 up even 2%. And the leader, the NASDAQ Composite, was up 2.7%. Of course, the more speculative the stock, the bigger the gain. Look at the pump in the ARK Innovation ETF, up 5.25%. The only speculative asset left out of the rally parade were the cryptocurrencies, which were down on the week, mainly due to the big declines that we had today. I'll talk about that a little later in the podcast, but the Grayscale Bitcoin Trust actually finished the week down 1.8%. So in the opposite direction of risk assets, but also in the opposite direction of safe havens like gold, which had a solid week up 2.5%. Gold had a very successful test of the 1,800 support level, and it closed the week at about $1,856 an ounce. And the gold stocks did even better. The GDX was up 6% on the week. And probably more important than the gain was the fact that the GDX rose every day of the week. 5 out of 5 days were up. GDXJ up 6.3% on the week, despite having one day that was slightly down. The interesting thing, too, about the gold stocks is they held up pretty well on the sell-off on Thursday morning, which initially had sent stocks tanking until they were rescued by Atlanta Fed President Raphael Bostic, who in a Q&A mentioned that he thought it was likely that the Fed would pause in its rate hikes by mid to late summer. And that's all the market needed, the pause by the summer, despite the fact that Bostic also said some things that might have indicated even higher rates for longer. Remember, everybody is still data dependent on the Fed, but the bulls were grasping for straws, and this is the one they grabbed. And that sparked a sharp turnaround in the markets. In fact, if you look at where the Dow closed today versus where it was on Thursday's low, that's a 2.25% gain. Same thing with the S&P, even a bigger swing from Thursday's low to Friday's close, a 3% rally, and the NASDAQ Composite swung by 4% from the Thursday low to the Friday close. Basically, all of the weekly gains were attributable to the Thursday-Friday rally, which was 100% the result of Fed speak about the potential for a pause. Now, also supporting the case for a pause was a bunch of weak economic data coming out all week. In fact, we didn't get any stronger than expected data, yet still weak until today. But looking back at some of the data that came out during the week, durable goods for January down 4.5%. It was supposed to drop by 4%, instead 4.5%. What they expected was bad. What they got was even worse. And as a matter of fact, they revised down the prior month from up 5.6 to up 5.1, although ex-transports, it was better than expected. Looking at the Dallas Fed Manufacturing Survey for February, the consensus was -9. We ended up with -13, way below the low end of the consensus rate, which was -9.5. Even the most optimistic estimate was a -2. So they were looking for weak, and they got much weaker. That was even worse than the prior month, which was -8.4. And the production index went from a +0.2 in January to a -2.8 in February. The trade deficit came out worse than expected for January. This is just in goods, the merchandise trade deficit, which is the bigger number because the unified deficit includes the surplus that America still enjoys in services. They were looking for a $91 billion deficit for the month. It came in at $91.5 billion. That is a huge number. Any way you look at it, that is enormous. I remember that the merchandise trade deficit that led to the 1987 stock market crash, the number that was so horrific that it was one of the primary catalysts for the 1987 stock market crash, was we had a $17 billion merchandise trade deficit in 1 month. Now, $19.5 billion doesn't even raise an eyebrow, where $17 billion back then was a disaster. The dollar was collapsing, bond yields were surging based on the fears of what that type of trade deficit would do to the value of the dollar and to domestic inflation. Today, nobody really cares about the enormity of these trade deficits, but at some point they will care. Remember, it's never a crisis until it is. It doesn't matter until one day it matters. Right now, the trade deficits don't matter. They do matter. It's just that people don't realize it. But when the markets start to fear these trade deficits, that's when it matters. But I guess then it's too late, because now you've got a crisis. We also got the Chicago PMI for February, another weak number. The consensus was for 45. We got 43.6. Anything below 50 is basically contraction, and we're way below 50. In fact, the prior month was 44.3. So the consensus forecast was for an improvement from January to February. Instead, we went the other way, and the Chicago PMI was weaker in February than the weak number that we had in January. Look at the Richmond Fed Manufacturing Index. Same story. It was negative 11 in January. The consensus was for an improvement to negative 5. Still a weak number, but not as weak as negative 11. Instead, the index dropped to negative 16. Way worse than the lowest estimate, which was negative 5. So again, we keep getting number after number that disappoints to the weak side on manufacturing. This flies in the face of a soft landing narrative, because it suggests that if we land at all, it's not going to be soft. But maybe this is one of the reasons that investors are believing that we're nearing the end of the rate hike cycle. We're going to get a pause followed by a pivot where we get our first cut. Looking at the PMI manufacturing number, this is the final for February. It came out at 47.3 versus expectations of 47.8. Once again, a weak number that was even weaker than the markets expected. Again, same story with the ISM Manufacturing Index for February. They were looking for 48, a weak number. They got an even weaker 47.7. The only thing was, it was a slight improvement over the 47.4 in January, but back-to-back weak months in the ISM manufacturing numbers. Looking at construction spending, again, January number, it was supposed to come out at plus 0.2. Again, a disappointing number. It came out at minus 0.1, and they revised down the December number, which was originally reported at minus 0.4, and that was revised to minus 0.7. All of this weak economic data coming out in the same week, and I'm not even finished. We got the productivity and cost numbers for the fourth quarter, and anybody who is hoping that the Fed is winning the inflation battle, these numbers throw cold water all over that narrative. First of all, on the productivity side, the estimate was for an increase of 2.5%, which would have been a slowdown from the 3% gain in Q3. Instead, productivity only rose by 1.7%. And worse, unit labor costs, which were supposed to rise by 1.4, which would have been a bigger rise than the 1.1 in Q3, they spiked by 3.2%. That is a surge in unit labor costs. So we have lower productivity, higher labor costs. This is not good if you think inflation is under control. The best way to control prices is with increasing productivity, but we're not getting that. What we're getting is increasing costs. And by the way, unit labor costs don't just mean wages. So when you see that unit labor costs are up, that doesn't mean that workers are getting paid more money. They may be, but that's only one component of labor costs. For example, a big component is healthcare costs, because when you employ people, if the employer is responsible for paying their health insurance, if premiums goes up, that increases unit labor costs. It doesn't benefit the worker that his health insurance is now more expensive because he's getting the same policy, his wages aren't going up, and in many cases, he's not getting the same policy. Sometimes what happens is, even though the insurance companies raise their rates, they also raise the deductibles, raise the copays, so you're actually getting a less valuable insurance policy. Your employer is just paying more money to provide it to you, and that's running up labor costs. Also, regulations, taxes, a lot of things increase labor costs, but they don't put more money in workers' pockets. In fact, a lot of things that the government does to increase labor costs results in fewer people getting hired, because the government makes it so expensive to hire people that businesses try to avoid hiring where they can, and so they hire fewer people as a result of these rising labor costs. But all of this flies in the face of the narrative that inflation is coming under control.